Hello, everybody, and welcome to the Tax Hack Show, where we give you all the best hacks to save you thousands, if not millions, on taxes. I am your host, Trevor LaParle, and I'm accompanied by my full-time guest, Kevin Brunner. Kevin is an expert in the financial sector and was featured in Forbes magazine back in 2015. He was previously the host for the Smart Money Hour on KABC Radio, Bloomberg Radio, and several other financial radio shows. Kevin has helped sell hundreds of businesses over the years and real estate as well. So hopefully he can teach us a thing or two here and there, right? Kevin, how's it going?
Good. It's going well.
Great. So the topic of today's show is capital gains taxes on the sale of a business and real estate. We're going to go over some of the options sellers have to defer taxes or avoid them completely and put themselves in the best position to not lose money. But first, let me formally introduce myself here. I am the co-owner of Comp Quality, a marketing company built around commercial real estate and business brokers, along with being a partner over at Q Financial. I've been around marketing for around 5 years now, have been immersed in this ever-expanding financial industry, and Kevin's really brought me into that sector as well. So Kevin, for you, can you give me a brief introduction for yourself as well?
Well, I'm an old entrepreneur. Built my first business in high school and then sold it my senior year in high school for more money than any of my teachers were making that year. So it's my mindset to be entrepreneurial. And after years of many things, time in the military, Marine Corps, time as a defense contractor even, my advisor convinced me to buy part of his practice while he was retiring. And I made a career change in 2004. He had encouraged me for a long time to do this. And he knew me better than I knew myself. He kept saying, you'll love it. You'll love it. You're built for this. This is what you should be doing. And of course, I'd known him since the 80s, right? And he was right. I love what I do. And but because of my past, my clients tend to be business owners. Because that's who you relate to, because that's my past as well, right?
Of course.
And then we have a couple of niche things that we do that are tax planning over and above the financial planning.
Love that. So for the most part, on this show, we're going to be talking about capital gains. We're going to go over a lot of financial planning. We're going to range from everything. So you're going to be the go-to guy for me and everybody else as well, which is absolutely something we love. So to start off here, we're going to go with capital gains tax. But for those of you who are only focused on the business side of things, we are going to split up this podcast there for you. So if you want to take a pause, skip ahead, or if you're focused on the real estate side of things, we're going to skip ahead for you guys as well. I'm going to put a note on the screen here for you with different timings. So like I said, if you only want to focus on, you only have real estate, you don't have a company, that side of it doesn't apply to you, go ahead and skip ahead. Not a problem at all. Okay, so let's assume not everybody listening has a full understanding of the capital gains tax. Kevin, can you give me a quick breakdown of what capital gains tax is and what it applies to?
Well, it's a chance for the government to sneak in and grab a percentage of your profit as if they were your business partner. But all they do with bureaucracy is make your life difficult, and they still want to snatch, 20, 30%, depending state and federal, of your hard-earned gains. Very often, if you have a loss, they make you take it over time. But if you have a win, they want their money right up front. So that's my cynical view of it. A little bit of humor in there. Capital gains tax is a percentage of the gain. So let's say you buy an investment for $1, you sell it for $2 later. $1 is the gain. What folks don't realize in the case of a business or real estate or some other assets, depends what the asset is. It could be a semi-truck in a trucking company. Your CPA, if he's doing his job, he's maximizing depreciation, even accelerating depreciation. So taking that 27, 29, whatever year schedule and compressing that to get you more deduction. And that's a good thing. That saves you money right there, right up front, okay? So when you go to sell that asset, though, now your basis, so let's say you bought it for $1 and you've taken 50 cents in depreciation. When you go to sell it for $2, now you're taxed on that $1.50. Remember, the government never gives you anything they don't want back with interest. So how do we not give that back to them? Well, that's where we come in. We have strategies to defer the tax or eliminate the tax. Then the question is always defer until when? Until the day after? Never, if you do it correctly. Or we can defer it, and while it's deferred, we can eliminate some of it through some tax planning. Now, but I want to say something here. I am not against taxes. I'm not even necessarily against income taxes. Now, I hate both political parties because I'm a libertarian. So I think both of them one's got their hand in your right pocket, the other one's got their hand in your left pocket. And I just want them to get their hands out of my pocket, right? So,
Absolutely.
But I'm not against taxes. I mean, if you really don't want taxes, well, then don't call 911 and hope the neighbors help you with their garden hoses on the house, right? Right. So
Pretty much, yeah.
yeah, don't send your kids to a state school or a public school, prepared to pay a toll every time you leave your house to drive on the roads, right? So, although those should be paid by other taxes, gas taxes and things. So, I'm not against taxes. I'm not an anti-tax person, believe it or not. You must have taxes to provide for a civilized, structured society. It's a necessary thing. But taxes are just an expense. This is my paradigm of how I look at it. And like every other expense, it must be managed. And it's not about paying your fair share. I mean, if you're not taking that money as income and you're just reinvesting it in the next thing, that is better for the economy than taxing it. So I'm all about, you pay tax on the income that you use to live on, but try to defer the taxes and everything else as much as possible. Defer it and reinvest the whole dollar, not the 60 cents you were left with after all their taxes. And that's our approach to it.
I love that. So give me a little bit more details on that. I know you mentioned deferring the tax. Is that the entirety of the tax that's deferred? I know we mentioned capital gains, but what are the different variables included in that process of selling a business? What's taxable? What's non-taxable? Can you give me some more details on that?
Well, the gain is taxable. So in the case of selling a business, whatever you sell it for over and above whatever you've depreciated your basis down to. So let's say you bought the business, I'll use round numbers again. You bought the business for $1, but you've taken a lot of depreciation over time and you got some inventory and you wrote off those new trucks you bought in only 2 years and things like that, right? You've even taken depreciation on the building, the property that you may own along with the business. So the gain is the tax over and above whatever your new basis is. So you bought it for $1 and you've taken 50 cents in depreciation combined with all the other things, right? Well, now your new basis is 50 cents. So when you sell it for $2, that whole $1.50 is taxable under a gains rate. Now, the gains rate is generally less than the earned income rate, but it is still a tax. So yes, it was good getting that depreciation benefit early on because that left more money for you to reinvest in your business as you go. But they're going to get it back and then some. So business owners, when they go to sell, they're very shocked. They'll run the final numbers with their CPA. Now, initially, they call their CPA and he goes, so how much am I going to lose in taxes? Well, the federal tax rate's this. And they just throw some numbers out there. Very rarely does the CPA actually run a specimen return, a sample return, making certain assumptions through the software. And Lacerte will do it. Heck, even something as cheap as TurboTax will do it. You can run that and then add in what the other taxes are based on current basis. Now, some things you can't defer the tax on when you sell, like inventory, but we have ways of obsoleting that, selling it cheap, and then the other people can take it into their inventories. That we have ways of doing that. There's also the recovery of depreciation, and we have methods of not recovering most of that coming into what we call an installment sale trust, and then going to the new owner at full value. So it's a method of, I might be getting ahead of us here. It's a method of not recovering most, probably 90% of the depreciation you've taken, and deferring the gains on the true gain on the sale.
Gotcha. So you're starting to go into different vehicles that you can utilize to sell your business that are tax advantageous to you. I know you just mentioned the installment sale trust being one of them. Can you give me a couple different snippets of the installment sale trust for one and different options that business owners can utilize to sell their business that is advantageous to them?
Yeah, exactly. There's many methods out there. There's some are better than others. Most have tremendous expenses that are paid to the people providing the service. A lot of those expenses are not necessarily disclosed up front, so you have to be very careful. You need to dig in. Those are paid out of the assets in the trust and things like that. Some of the methods allow you to be the trustee, like the variations of charitable trust. Some of them are called charitable unit trust, CRATs. There are different methods of charitable trust. Now, I'll warn your listeners right now. The IRS is actively auditing charitable trusts right now because there's lots of abuse going on there. But what they're not really doing, usually the trustee, which ends up being the client, doesn't keep up the paperwork and the filing and the tax returns and do it all correctly. So the minute they find out you're not compliant, they just collapse the entire trust. And so we only do the charitable versions if the client will hire a professional fiduciary trustee to manage it. The client wants to do it themselves. We don't want to be a part of it. All right. So here's some of the different versions. So they have variations of the installment sale trust. It all goes back to an Ernst & Young program from the 1970s. It's still around. Mitt Romney used this to exit Bain Capital, and that's why he deferred the tax. And everybody said he got away with no taxes on $100 million. That's actually not true. There's the installment sale trust, was just tried and true. We're coming up on 50 years soon of that being around. IRS never has a problem with any of it. Then there's other versions, the Kratz, and there's something out there called a deferred sale trust. Well, they're okay, but they're incredibly expensive. The fees, expenses are just outrageous. Then there's something else called a monetized installment sale. If you're not doing agricultural land or ag product, like you can sell the pigs to the slaughterhouse and monetize that and defer the tax for 30 years, but you can't sell the pork, the final cut up pork, because that's an after product. You can sell the grain to the granary. You can't sell the flour. Okay.
So essentially you need the raw product, right?
Yeah, the raw product, the grapes before they're sold to be processed, right? So we have vineyards we're helping with that. We have a bunch of walnut farmers we're helping with that. So, and we have believe it or not, the cannabis industry we're helping with that right now. So that's called a monetized installment sale, but it is very specific to agricultural land in the immediately harvested whatever the product is. If you ever see anybody offering a monetized installment sale on anything else, the IRS is right now just keeping a list of all the people that have done that, and they're assembling their team to go out and audit all of them all at once. We have that directly from the IRS, that's their intention. It's also on the Dirty Dozen list. The IRS every year publishes a Dirty Dozen. That's been on the list, the monetized installment sale for non-ag, for non-agriculture. It's been on the IRS's Dirty Dozen list for a long time now. So there's many methods of doing this. In the case of real estate, you can do a 1031. But then you got to buy a DST or a REIT, or you got to buy another property. And then there's strict limitations on that. And you got to buy something that has the same ratio of financing and all that. It's difficult. Now, an accommodator will help you comply with it, but you have to pick a property in 45 days. You got to execute in 180 days. And those are all arbitrary timelines the IRS added to that later to make it really difficult, because they're hoping you trip up and they get to tax the whole thing.
Yeah, right.
A dirty little secret on 1031 exchanges for real estate. When they say 1031, that's Internal Revenue Code Section 1031. That's where those numbers come from, right? Is people end up paying tax on a portion. Very often the numbers don't line up and a portion of the transaction becomes taxable. And now the other end, they got to come up with some money and pay some taxes, even though it's all tied up in a piece of real estate. And that can cause a lot of problems as well. So there's many methods for deferring tax.
Great. Let me butt in real quick. I have a quick question. So I know you mentioned a little bit earlier talking about, the trust being under you or having a trustee. What are the benefits of being under your name as a trustee in comparison to somebody else?
Well, it's a false sense of security that you're the one in control, but you're also the one that's completely responsible for any mistakes that you make. And you're probably overconfident on your skill set to deal with the IRS when they show up knocking, asking questions. The auditors I know at the IRS that we communicate with, because we have what's called an open best practices relationship with them. They just want to wait 3 years till after the charitable trust is created, or CRED or whatever. And by the day one of the fourth year, odds are 2 out of 3, when they show up, you won't have all your records straight. You've not managed it correctly. They can collapse it all and tax it all.
Got it. So the goal is essentially to trust the trustee and delegate that to somebody else, because chances are you don't know how to go into all the details that come into that. And chances are you're going to get audited if you don't, delegate that to somebody else, right?
And here's what happens. The client always comes back to the advisor and say, you recommended I do this. I just lost an audit. Now I got problems, right? Because now you're blaming me for telling you to do it. So we don't take clients if they want to be their own trustee. If you want to do that, go somewhere else, because you're going to screw it up. I mean, it requires professionals to do these things, and
Yeah,
you don't have time to do that on top of the rest of your life. I mean, you're not doing your own dentistry, right? And you only got to see that
absolutely.
guy twice a year, right, for a
Yeah.
cleaning. You don't try to do that yourself. Why are you doing this? And it's not expensive. It just isn't. And having a professional trustee gives you something else. You see, if he makes a mistake, he has malpractice and errors and omissions and fidelity bonds. You're covered. You make a mistake, you're not covered. You can't even buy the insurance for yourself. So you're 100% on the hook.
Got it. So you have that
So
sense of
it just
security
is,
around it as well. Sorry to interrupt, but
yeah, being your own trustee on anything more than your living trust, which is just an estate thing, being your own trustee on anything more than that's like trying to do your own dentistry. Why would you do that? So,
yeah. Like you said before as well, trying to, go to your dentist, you're asking for hard advice, right? You can't ask your dentist for hard advice. You can't bounce around for different people. It's not ideal. But I know you were tapping into real estate a little bit just a minute ago. I wanted to touch back with that. You were mentioning the REITs, the REITs, 1031 exchange. How does the things we mentioned before with the deferred sales trust, installment sales trust, how does that apply to real estate or commercial properties or rental properties as well?
well, if you have let's say you have an apartment building and you're just tired of being a landlord, but you don't want to, you can 1031 into a REIT. Now, generally, they're going to send you to a securities broker dealer firm. They're going to sell you a non-publicly traded REIT, which it has an offering memorandum and everything else. But now you're beholding to them, and exiting them involves stiff redemption fees. If they're not managing things well, heck, if the economy tanks, like in 2009 and 10, there were people who had money in REITs and they couldn't get out,
Oh, wow.
could not get out. I mean, you could get out by selling your position to somebody, but then now everything becomes taxable. Um, you're going to have to sell it at stiff discounts. The income stopped. Um, Also, DSTs. Now, when I say DST, I'm talking about the Delaware Statutory Trust.
Okay.
Each one of those is unique. So if they're not managing things correctly, if things don't go well, the economy goes, you're stuck. And you could take some serious losses there. The other thing, those Delaware Statutory Trust will finish the portfolio they have, and you'll get 90 days notice that we're done. We're going to cash everybody out. And now you're scrambling to find where you want to go, right?
Yeah.
So it's just not ideal. And we have this video for clients, and it talks about REITs and DSTs, how they rarely perform like the brochure promises. Okay, if you were to use something like an installment sale trust, an installment sale trust is actually very simple. They're not that complicated. Now there's 85 years worth of tax court rulings you have to comply with. We've already baked that into the cake. You don't have to learn how vanilla is grown and roasted and extracted into the spirits. It becomes the vanilla you put in the cake. It's already in the cake, and we've already taken care of that, right? You don't have to learn how to whip that butter frosting to get it just right. It's already on the cake. That's what we've done. So our documents are literally templated. They're fill in the blank. It's a very simple process where you can transfer into this trust any asset except for publicly traded stock. It's sold to the final buyer in the same escrow process as a 1031 would have been, except for rather than money going back to the 1031, what they call an accommodator trustee, it comes back to an IST trustee, that is a fiduciary managed trust account. And the trust and its assets are secured by a note that you hold against it. And nothing can go anywhere. Your quarterly payment doesn't even come out until you log into the bank's website, put in a 6-digit code that you have an app on your phone provided by the bank, and approve the payment coming out. So you have complete control over the collateral for your note, which is the trust and the trust assets. And that all sounds more complicated than it really is. What I'm getting down to is nobody can Bernie Madoff your money. They just don't have access to it to do it. So anything they do managing, you must approve. So the installment sale trust is the simplest way to do that.
That's great. Let me butt in real quick. So I know you mentioned about putting your rental property inside. What if I have, 2, 3, 4, 5 rental properties? Do I have to do individualized trust per transaction, or how would that work?
Oh no, my record's 36.
36 in one
36
transaction.
properties, 36 single family homes that were all sold in one by one by one by one. And now how would that person ever have coordinated 36 1031s?
That'd be a headache and a
How would
half.
they have sold them all to an accommodator trustee, complied with the, for a 1031, applied, and had the 45-day, 180-day rule? It's just, there was no way to do that. What they were doing was they were selling all of them because they wanted to buy apartment buildings. They wanted to get out of single family homes and go into multi-unit buildings. Once all the money was in the trust, then the trust made the investment into the multi-unit buildings. And we have a method of doing that that's fully IRS compliant.
Okay, so you're saying, is there like a limit on the amount of transactions you can have, or you can put an unlimited amount inside the trust?
It's unlimited. Now, when
Got
you
it.
look in the tax code, by the way, just to let you know, in the tax code, they say it's 5 million per husband and wife, 10 million total. Then you read several paragraphs later, and then you say, well, it's actually unlimited. There's just a fee on the amount of the gain over 10 million on the tax not paid. So there's a fee on the tax. So it ends up being basis points for you to calculate. So in other words, it's unlimited. You can do 100 million. The largest one we've done was 72. And
72 million?
Yeah, as I remember, that was a solar field
Oh, wow.
with multiple partners.
Yeah.
And they sold it off. So, but it wasn't all into one trust. There were multiple partners totaling the 72, and each one had their own unique trust.
So it's just, there's more of a fee that comes with it when you add over 10 million, from my understanding, is what you're saying, right?
Yeah, there's a fee to the IRS on the deferred tax, but it's a lot cheaper than paying the tax.
Yeah, I can imagine, right? So
Yeah, the fee is a fraction of what the income taxes would have been, or what the income taxes are earning in a rate of return for you while in the trust.
yeah, especially on a transaction that's, $72 million,
But
that
it's
tax
only
would be.
but it's only on the taxes on the portion over the 10 million gain. So
Got
it's
it.
truly
It's like a
it's
bracket
it's
system, essentially, right? Kind
yeah,
of like the
yeah,
normal tax
yeah,
rate.
yeah,
Yeah.
it's a bracketed thing. So every time we've run the math, the person says, "Oh, well, yeah, fine, that's cheaper than paying the tax. Okay, let's go."
That's the way to do it, right?
Yeah.
Love it. So one more thing as well. I know we talked about with the rental properties and things like that. If my business, kind of circling back to the business as well, can I apply the business property inside of the business transaction as well, or how would that work?
Oftentimes, a business owner will own the real estate in an LLC separate from the business for asset protection reasons.
Okay.
There would be two transactions. There would be the business into the installment sale trust, and then the real estate. And it usually even closes as two separate escrows. And we coordinate with the escrow companies for all that.
Okay. And so what if I potentially, I wanted to sell my business, and then instead I wanted to maybe, keep my property for another 10 years, and I'm okay with managing that? How would that look?
It usually doesn't work out too well for them if they want to keep the property. Let me tell you why. Very few business owners are charging the business market rate rent for that property. They're not paying themselves from the business market rate rent. Okay.
Okay.
When the new owner takes over the business, if his new numbers are market rate rent, because now all of a sudden you're going to want market rate rent on that property, right?
Of course.
Well, that skews the profitability of the business, because now you've just increased its expenses. So that reduces the value of the business. And this will be worked out by the brokers before you close escrow on the negotiating. So you can sell the business for less because the rent's going to be higher because you're keeping the property, or you can collect less rent on the property than market rate rent and give them a lease for the amount you were paying all those years, right? Which is usually, I find it's usually about 20% of what market rate would have been with most business owners. Or how about you just wrap it all up and sell the real estate and the business together as a package? And it's actually easier for the buyer to get financing if there's real estate and business together in a package.
So why is that?
Because the bank, be it SBA or the bank or whoever's doing the financing, now has hard assets beyond the furniture, fixtures, and equipment in the business, which is the real estate.
Got it. Kevin, thank you so much for your input. That's going to conclude our conversation for today. Of course, we'll be back next week to talk about everything in more detail. Make sure to let us know in the comments, guys, if you have any other topics that you want us to go over that apply to your personal situation. Maybe you have a company with real estate attached, or maybe you only have real estate or multiple rental properties, and you want to get an idea of how one of these would work for you. Please let us know in the comments below. The plan for next week's podcast is going to be the gift tax and why you should think twice before passing down a business or property to a family member or a friend. So thank you guys all again for tuning into the Tax Hack Show, and we'll see you next week. Kevin, thanks again.
You're welcome. Thanks.